Hi, it's Jackie and George. Welcome back to our channel. Today we have a very important topic to discuss: what home buyers need to do now to purchase a house before interest rates fall.
So we've been talking about this a lot, and we expect that the interest rates are going to drop in the coming months. And we're filming this in the beginning of September. You're going to see an indicator coming up in just a couple of weeks. If they don't raise the rates, that's a great thing. When they get down a little bit lower, there is going to be a flood of activity.
That's right. When the interest rates decrease, it's going to be like a Black Friday sale, but for houses. Everyone's going to be vying for that one coveted property, and it's going to be really hard to get.
So how do you prepare for that? We know that the answer is talking to your lender now, making sure that you have everything in line so when the time comes, you're prepared to be the most informed person. In fact, we brought in somebody that's an expert at this to give you some information. So let's go right now to our friend Dawson Walker. He's our lending partner with Waterstone Mortgage. I took a couple minutes to speak to him just a little while ago. I want to share it with you. So I have with me Dawson Walker. Dawson is my lending partner extraordinary, my go-to person about everything that has to do with financing. He works for Waterstone Mortgage, in my opinion, the best mortgage company here in the greater Orlando, actually in all of Florida and quite a few other states as well. Dawson, thank you so much for taking the time to join us.
Absolutely. Thank you for having me. I'd love to be here.
Well, so what we're going to try and do today is put aside some of the questions that some of our clients have, particularly when it comes to the house buying process. And specific to this, it's about the credit and getting pre-approved for a mortgage. And the big one, the big thing that comes out all the time is, should I pull my credit early? And what happens when I do? Does it affect my credit rate? And are there different ways I can do that? But if I'm buying a home, should I wait till the day before, or should I wait, or should I do this maybe a couple months in advance? What do you think?
Unless everything's perfect, I would definitely not wait till the day before. I highly recommend talking to your lender as soon as possible, as soon as you have the thought of buying a house. That way you can get your credit pulled, see exactly where you're at, and then you can formulate a game plan from there.
So you say getting your credit pulled. Doesn't that affect my rate though if I did that?
Yeah, so a lot of people think if you get your credit pulled, it's going to affect your credit, and there is some truth to that. But it's there's a hard pull and a soft pull. If you're going around and you're going to rooms to go, and you're pulling your credit there to get some furniture, and then you finance an RV, and then you go buy a car. If you have a lot of hard pulls that will affect your credit in a negative way, what I would recommend is going to your lender, have them do a soft pull. It gives them all the information they need, and it doesn't affect your credit at all.
So when you say a soft pull, so as you said, it doesn't affect my credit, which is great. And you and I talk about this all the time when we're counseling our clients on what to do. With a soft pull, you can still see if there's some issues in there. Is that accurate?
Yeah, exactly. It still gives you all the information you need. It just doesn't report to the bureaus. And so if you had, let's say you were an authorized user on your niece's car and then she didn't make the payments, but you don't even know yet, that could be affecting your credit score. If there's anything hidden or any unknown issues, then you could find them out right up front without it affecting your credit.
Oh, outstanding. All right, great. So what about proof of employment? Let's say I'm relocating from Illinois and I'm moving here to Florida, Orlando area, and I'm going to buy a home. I am in the software technology business up there, and I'm moving down here. I have a job I'm moving to. What about unemployment? What does that? What happens there? Or employment? Excuse me.
Yeah, so if you have a job lined up, that's amazing. So what lenders do is they look 2 years back because they want a 2-year work history. They look 3 years forward. They want to know that you're going to have a job once you get the loan so you can pay the loan off. So typically, if you get an offer letter from the new employer, whether it be salary or hourly, and it tells you when your start date is and what they're going to pay you, we can just go off of that.
Outstanding. Good to know. Good to know. How about this one? This is kind of a big one.
Oh,
DTI, debt to income ratio. What is that?
Yeah, that's one of the main qualifiers. The big three are income, assets, and credit. So the debt to income ratio is what your gross monthly income is, or what your monthly income is, versus what your monthly bills are. Car payments, credit card monthly minimum payments, student loans, things like that, things you have to pay every month, not including utilities or anything like that.
All right, so here's the question that jumps out. Let's say I've got a credit card where I've got a $20,000 credit limit on there. I'm up to around $15,000 on my credit card bill. My monthly payment on that would be a couple, $400 or $500. Let's just say that's the round number. That's used towards my debt to income. Is that correct?
Exactly. That counts against your monthly income. Ideally, you want your credit card utilization to be under 30%. So
So I know this one because you actually counseled Jacquie and I on this one. We want to keep our balance. If we have a $10,000 limit, we want to have less than $3,000 used when they're pulling our credit, showing we're under 30% of our maximum available credit. Is that accurate?
that's 100% accurate. Yep, under
And
30%.
what about a strategy to help improve your credit scores? What would happen if I had a car loan that was a year and a half, had a year and a half left on that? Is there any way to get that removed from my DTI, my debt to income, to allow me to finance more?
Yeah, so anytime you have installments, whether it be student loans or car loans, things of that nature, once you get down to 10 payments, then we can actually exclude it and not count it against you.
So real quick on this one, let's go to the car loan because this is an issue I've got right now. I've got my truck loan. I've got 16 months left. If I paid off enough where I'd only have 9 months left, not the full balance, but only had 9 months remaining because of my balance and what my payments are you saying that amount wouldn't show up on my credit as far as DTI?
Yeah, I'd exclude it, poof, out into the ether, and we would not have to count it against you if you're 10 months or less.
Well, and this is so, folks, for all of you watching, Dawson and I obviously work together very, very closely. He's my preferred lending partner, and we have these conversations helping our clients all the time. So, yeah, I kind of know some of the answers he's going to give because I've been on the calls as he's coaching people and helping them. Pulling your credit early allows us the opportunity to improve everything. Now, that brings the next question, which is so important. What are we looking at? Ballpark numbers. If I've got a $500,000 loan, and I've got a credit score at 700 or I've got a credit score at 760, is there a difference in what my monthly payments will be based on my credit score?
Yeah, there actually would be a pretty big difference. So there's tiers, and 740, 760 or another tier,
Mhm.
and the higher your credit score is, the lower your interest rate, and your interest rate's the biggest factor when it comes to your monthly payment. So if your credit score is lower, your monthly payment's going to be higher, and it can save you going from 700 to 740 or 760. I mean, it can save you hundreds of dollars a month and tens of thousands of dollars over the course of 30 years.
All right, so now I'm going to call you out and really kind of and honk on you a little bit. In your counseling of clients that we've worked together with and the ones that you work with all over the state of Florida, um, have you ever been able to help somebody get their credit score higher up by giving them a little counseling and some advices that they took?
Tons of people, and we actually most lenders actually can do a rapid rescore where if you pay a credit card down a little bit or if you do a certain thing, you submit it straight to the bureaus and it can boost your score in 4 to 5 days versus waiting for it to naturally report to the bureaus, which takes 30 to 45 days. So
However,
we've done it with hundreds of people.
terrific. And of course, the cool part is, of course, if we've got 90 days out, we're a little bit ahead of the curve.
Right.
So much can be done. Dawson, another question that comes up: what's a low credit score that really you can't loan on, and what's the highest credit score you can get? Where's the tier in there?
Yeah. So the lowest credit score you can possibly get a loan with is typically 580. There has to be other factors. If you have a low debt to income ratio and you have some assets, you have money in the bank. Really, if you can get over 620, then we can make a FHA or a first time home buyer program work pretty well. The highest credit score is usually around the highest credit score I've ever seen. I think is 814. So that's like anything over 800 is the highest tier there possibly can be.
Terrific. So another question that comes up when we're talking about all the money that goes to your debt to income ratio, if you have to pay alimony or child support, is that part of it?
Yeah, whether you receive or whether you have to pay child support or alimony, that is part of it. So if you're receiving it or if you're paying it, if there's a 3-year continuance. So if the child is 17 and they're only going to get it for another year, then you would not count it. If they're going to receive it for another 3 years, then you would count it.
So what if they're only receiving it for 2.5 years? Does that mean that they wouldn't count it?
That means we would not count it. Exactly.
Okay, so that's kind of cool. That's a little different than we just spoke of, which is that 10-month. Now we're going up to a 3-year for the child support and alimony. Good to know.
Right.
That's an important one. A lot of people freak out about that.
Yeah, they consider it income, whether you're giving it or receiving it, and so, like I said, they look 2 years back, 3 years forward. So if you're not going to be paying child support for the next 3 years, they're not going to count it against you.
And along those same lines, because I want to make sure we cover everything, is there a minimum income that somebody needs to make to be able to qualify for a loan?
Yeah, so I mean, the best way to answer that, let's say they're buying $100,000 house. If their payment's 1,500, if they want to total up all their bills, it's typically the debt to income ratio needs to be 50% or lower. Sometimes you can go higher with first time home buyers. So if you just think about your bills and what you make, and your bills have to be half of it, but you have to also include that new mortgage payment.
Well, and of course, the logical thing to do is to call you or call their preferred lender
Yes.
and say, listen, let's take a look. What do I qualify for? We encourage everybody to do that. So here's the thing, and for everybody watching, I just want you guys to get this. I'm going to put Dawson's information in the comments down below. You can reach him on any questions. He is servant based. He's about helping. He's also surrounded by a team of just incredible loan officers and servicers and just amazing service. It's why we're in business together. I want to thank you for your time more than anything, Dawson, and thanks for your advice. I'm sure we'll be calling on you. I hope some of our viewers are going to call on you as well for some questions, and I'll probably talk to you tomorrow. Hold on.
Awesome. Thank you, George. I appreciate you having me on, and it's awesome talking to you as always.
So there you have it. The bottom line is be prepared sooner rather than later. You know the old adage, the early bird catches a worm. But in this case, the early buyer gets their dream home.
And speaking of that, it is something we've seen for years and years. I think it's always been this way, that the best homes go very quickly. You need to be properly prepared so when time is right, you can move and be the first one there. We can help you with it. We'd love to do so. If you like this kind of content, please hit the like, subscribe button. It gives us an indication we're doing something that's valuable to you. But more importantly, we're here to help if you need anything.
If you have any questions for us, you can drop a comment down below or just reach out to us. That's it for now. See you next time. Bye.